Good evening. Thank you so much for joining us for this briefing on the Chief Economist's outlook and where the global economy is headed, what we can expect in 2024. I'm thrilled to have with me three panelists that will tell us about different sectors, different regions, and also their different outlooks as to what may be happening globally. I have immediately to my left, Ludovic Subran, Chief Economist, Allianz Germany, and also a young global leader at the World Economic Forum. Welcome, Ludovic.
Thank you.
Next to him, we have Karen Harris, who is Managing Director of the Macro Trends Group at Bain & Company in the United States. Welcome, Karen. And finally, we have Mario Magalhães Carvalho Mesquita, who is Chief Economist of Itaú Unibanco from Brazil. Welcome very much,
Thank you,
Mario,
Thank
as well. We launched yesterday here at the World Economic Forum the Chief Economist Outlook, which is all of you, plus another 50 of your peers, together giving us some views as to what is happening globally and what might be happening in terms of the growth outlook in different regions, what might be happening in terms of inflation. And this year, or this particular edition, we do this every quarter, we did a bit of a deep dive into industrial policy, industrial strategies, and what that might mean for the economy. And we also looked at artificial intelligence. Let me give you some very quick highlights as to what we found. Uncertainty is very high. I think those of us that have been here in Davos now for about a day have picked up on that as well. The 56% of the chief economists believe that the global economy will weaken in 2024, but 43% actually foresee that there might be unchanged or stronger conditions. And I think with this group of 50, we've seen that there's very divergent views, but that's roughly where we end up with a slightly more negative outlook. Now, the IMF has forecast a decline in global growth in 2024, so 2.9% for this year versus 3% last year. And over the next 5 years, an average of 3.1%. So we're looking overall at a pretty weak outlook in the medium term. In different regions, different outlooks. So according to this particular outlook, the view is that the strongest growth is likely to be in South Asia and in East Asia and the Pacific, with the exception of China, where previously very strong expectations are now down to moderate expectations for about 2/3 of the group, but still moderate expectations rather than an expectation of decline. The outlook for Europe has weakened significantly, so that is where our September survey was looking pretty good for Europe, and this time around about 77% of the chief economists expecting very weak growth or weak growth for Europe. USA and Middle East and North Africa also turbulent, again, understandably. 6 out of 10 of the respondents are seeing only about moderate growth in those regions. And finally, some slight improvements in Latin America, in Sub-Saharan Africa, and in Central Asia. Now, I will take a pause here. That's some of what we picked up as to what's happening around the world, and we'll get into some of the other issues afterwards. Let me just turn it over to each one of you and share. You must have had one particular view when you answered that survey, and there's obviously enormous amounts of research behind those views. So Ludovic, let me maybe turn it over to you. Your expectations for 2024 and why?
2024 is a very, complicated year because there are a lot of assumptions behind it. Everybody is actually looking already in 2025 and what happens after the US election. So there is a flavor of muddle through, and there is a flavor of successful soft landing, both for the US and for Europe. And so that is potentially not too bad for the world, while China reignites a bit growth. So I'm a bit on the camp of actually we managing it. Of course, risks are tilted to the downside. Normalization comes with a bit more insolvencies, a bit more unemployment, but it's okay-ish. But there are strong assumptions, for example, on fiscal policy. When you look at US growth, when you look also at the odds of a soft landing in Europe, it boils down to fiscal policy. And so that's why it's a very difficult outlook, because we have one engine of growth left, which is domestic. I mean, trade is slightly picking up again, but domestic growth is, what's going to happen in housing. So that boils down to policy making, the policy mix with monetary policy and fiscal. But a lot is about how much are states ready to consolidate after having done whatever it takes for 3 years? Are they ready to let go of it and then go into full recession? And we've seen a few countries. My country, Germany, has experienced recession this year. It's one of the few big countries that has had this recession. So it's a bit of a leading indicator of what could happen when you start to really go at the bare engines of growth. So I'm a bit on the optimistic side for now, but I think the job has to be done. And of course, 60% of the world GDP is going to the polls. So vote well is the message.
Thank you. We're going to pick up on that. Karen?
I have to laugh when I hear those numbers. I think there are many things that economists do that are incredibly irritating, but one of them that we do is basically 30% means we're convinced enough that if it happens, we can say, well, we said there was a pretty strong possibility last year that that would happen. So when I hear these split numbers, that's pretty much a confession, as Ludovic was saying, is like, wow, there is a wide divergence of potential outcomes. And also, economic models are in many respects built like thrumming a rubber band. They collapse back towards last year in their construct. And so when we think about this, working with businesses, the questions we're asking are, what are the potential big disruptions for next year, and how resilient are we to those? We've heard a lot about, for example, the resilience of the U.S. consumer, and I think in some respects that's overplayed, right? Consumption has outstripped income. That America's very good at that, but even we can't continue that in perpetuity. There's, of course, the election is causing a lot of uncertainty, but underlying that, I think I think that we can actually be a little bit complacent about some of these cyclical risks in the U.S., given some of the long-term structurally positive factors that are happening, not just the early signs of labor productivity, but where we think that is heading, the tax policy, and of course the IRA and other investment policies that have basically been a great big fiscal stimulus. That's always helpful. It's part of why we had such a good year. And while we think we're going to have a rather chaotic year in the U.S., we remain, for businesses looking out over 3-5 years, probably more optimistic than consensus. And on the European side, less complacent about the near term, or less concerned, but really worried about some of the structural challenges, demographics, and energy costs being among those that I think create a bigger headwind. And so, of course, we all want to know if there's a recession or not. I guess the last thing I'll say is when we talk about a soft landing, when we think about a recession, it's like an airplane going, sort of going nose first. And a soft landing is the plane landing maybe without the wheels scraping along the runway. So it's not going to be a flawless economy under any circumstances, but you can hear from just those numbers that there's still a lot of uncertainty, and it's really about your conviction around the disruptions and do they matter to your businesses and investments that we're focused on.
Thank you, Karen. Mario, your outlook globally, but also specifically for your region.
For the region, we are also in the soft landing camp. We think that the world economy will grow around 3% this year, a little bit less than that, less than the average for the century. Probably building up some slack there, which will allow inflation to come down, but with limits, right? Labor markets are tight in many countries still, so it's a soft landing, but we need to see a landing. So we think that on the whole, the market is too optimistic about rate cuts in mature economies. It's not that they won't cut, but probably not as much as is priced in, because if they do it, we may not even have a landing, right? And then they may need to overdo in the other direction down the road, right? So we are a bit cautious on that. Still, rate cuts, especially by the Fed, should be helpful for Latin central banks. Central banks in the region, they never were that confident about inflation being transitory because of our history. You know that it always starts transitory, but if you are lenient, it becomes much more persistent. So they understood that, they acted fast and aggressively and early, And they have been cutting already for some time, and they'll continue to ease. And of course, as the Fed also eases, this will, their life will be a bit easier. We have an important election in the region as well, in Mexico. Most likely, Mexico will elect a female president. The two main candidates are female, so it's almost a given, right? And interestingly enough, this time we think the election north of the border is more likely to impact Mexican assets than the election in Mexico itself, right? So it's a decent environment for EM. Not a great one because the world economy is not growing that fast, and for Latin America as well. One question mark is China. China is very important. It's the main trading partner for South America, right? And it's an economy that is growing less than it used to, and it's increasingly becoming more reliant on stimulus to grow, right? So it's 4 to 5% this year with stimulus, right? We don't know how much or how fast it would grow without those props. Okay.
Thank you. I think each of you has alluded to a little bit of the geopolitical outlook. You've all talked about elections, and probably over the last couple of years, most economists have also had to become political scientists and become geopolitical experts as well.
Epidemiologists.
Also. And let's not forget technology. So we also asked in the Outlook about what their views are around geopolitical and geoeconomic fragmentation. About 70% expect that the pace of geoeconomic fragmentation will accelerate this year, and only 13% are expecting an expansion of any kind of economic globalization. So maybe we just do another rapid round with the three of you as to your views on that, and what are some of the big geoeconomic and geopolitical factors that you think will impact the outlook this year? Ludovic, over to you.
I'm here. Short, good news, trade is coming back in positive territory, so the trade recession is behind us, also because China is stimulating the economy, so that's good news on globalization. Second, the number of protectionist measures in the world this year has increased 38% compared to last year. Bad news. Good news, we are getting used to it. It's a friction trade, friction globalization. Bad news, we start to go at each other's investment flows and not only on trade. If Trump's come back, the problem is not going to be on the current account. He already promised to increase tariffs by 10% and triple tariffs on China. He's going to go on the capital account. That's not good because we know that its investment flows can actually really get a country's balance of payment off the cliff. So I'm a bit worried about protectionism going into the financial account, and that is much harder to manage, even for international institutions, but also for businesses. Yeah, that was short enough. Yeah? Okay.
Thank you. That was great, Karen.
I think there's a domestic issue in that it zaps policy strength. I mean, if 99 out of 100 economists agree that inflation's too high, bankers will raise rates and the markets won't fight it. But as we heard, there's a huge divergence in points of view. We've seen data that shows just the standard deviation of expected interest rates means we'll either have a recession or a big one or none at all. Great, not helpful, right? And so that, I think, is the decisiveness of policy, and the speed of it becomes, there's a headwind. At the international level, fragmentation means higher costs of capital. And we all know that interest rates aren't going to go back to where they were. That's just one factor in that. Investment flow competition is part of that for sure. I think the opportunity there on the good news, bad news scale, the good news is that we were operating in a world where a lot of industries were dictated by scale at a global level. And when capital flows are more domesticated, are regionalized, and where we can't serve certain industries out of some regions and others, it actually opens up a lot of opportunity for growth and investment that didn't exist before when you couldn't operate at global scale. So it's different. It's not necessarily bad, but it is a change.
Yeah. I think that the environment and the deglobalization story has a heterogeneous impact across countries. In the case of Mexico, for instance, is a country that is already benefiting from nearshoring, right? Mexico was poised to grow a lot after NAFTA was signed, but it was at more or less at the same time China joined the WTO. So when it started to gain market share in the US, China came and took Mexico's market share. So they are now on the opposite side of that movement, right? And they are likely to benefit. South America in particular was never that open and that integrated in the global economy, right? It's particularly my own country, Brazil. And so we never globalized fully, so we're not going to deglobalize. But what concerns me more is beyond trade, is, as Ludwig said, fragmentation at the capital market level, right? And this is a concern that I started to hear recently here, including in Davos, right? And it's an issue that might lead not only to worse production and distribution of goods, but also a worse allocation of capital.
Thank you. I'm going to go back and forth with a few different topics. One of the deep dives that we did this year, and one of the topics that is very high on the agenda here in Davos, is of course artificial intelligence and what its impact is going to be. And briefly, at least in this outlook, the sense was that in high-income economies, this is going to lead to a lot of increase in the efficiency of output production. For developing economies, far less so. So 80% came in thinking this is going to be very useful for developed economies, and only about 38% believe that that would be the case for developing economies. And of course, we were asking them to look at just the next 3 years specifically. And 50%, and again here, very split views, 50% of the chief economists expected generative AI to be commercially disruptive this year. So very different viewpoints there. Just tell us a little bit more, including that north-south angle and how digitized some of those economies currently are.
Well, just throw one point on the north-south divide. We just did a paper on India and the levers for growth for India, and also the challenges, climate and so forth. You know, it's fascinating to see how much of a top-down view we have on, you know, India has been developing these services, outsourcing, and now they're going to lose all these jobs because AI. And then you talk to Indian entrepreneurs and they tell you, you know what, we're going to leapfrog all these lacking universities, because the Indians are very smart with training and they're going to self-train, and AI is going to be the maximum accelerators for human capital gains. Go figure, go tap that, you know. Which, you know, American university or which European university is even thinking about using AI? They're all thinking about blocking it. So I think we haven't seen the beginning of it. I think it's, you know, I started working, I always had a phone, internet, and a computer. But I know people in the office when I started 20-something years ago, they were telling me, oh, you didn't know like the punching card, and this is going to be our revolution. And I think we're going to lead, and we're going to see so many innovations coming from the South. So we shouldn't be so definite about who's going to be on the edge and on the race. Yeah.
And AI's impact on growth more broadly? What's your...
Oh, I think it's going to be very strong. I mean, at least if we believe markets, given how much the Magnificent Seven and, you know, the markets have front-loaded of gains and the productivity gains. We're talking about 2-3% of productivity gains just for the US. I think the question is the diffusion, the transmission of this. I'm quite positive on growth, but just like this huge transformation that are exponential, systemic, and highly probabilistic in terms of success, they come with winners and losers. And I think the question is going to be whether we are really fully thinking about this, unlike globalization maybe 20 years back, thinking about how we make sure we really focus on enhancing the winners while protecting the losers, so that people don't have the impression they lose too much, because that would be huge blockage and huge counter forces to the true development of AI, especially for white collars. I think it's going to be like the Luddite revolution. It's going to be like a, you know, fifth industrial revolution. I think we really need to think. I think it's very growth enhancing. My point is the points of rupture for the social compact are so strong that it can only generate growth if we really care for the one left behind as we build these growth-enhancing moments and policies. Yeah?
And do you expect it to be a net positive or a net negative?
Net positive.
For jobs?
For job, I think it's going to be net positive because I hope we're not going to have to answer 120 emails a day. AI is going to do it for us. As an economist, it's going to be the ultimate fact-checking. I'm going to be presenting today, and then I'm going to be saying something, and then if you say, oh, I want to know the number for Mongolia, I'm going to like Mongolia, and the number will show up. So I will focus on, caring, belonging, empathy, math skills. I'm not going to be focusing on memorizing numbers, which I've been good at. But I think it's going to enhance us. I really believe so. But of course, we shouldn't turn a blind eye. I also have a backup plan to become a massage therapist if ever AI doesn't work, for me as an economist. But I think it's up to all of us to make it count. It should make. Look, one statistic, sorry, I just mentioned the statistics last week. The highest number of burnouts, mental health issues, are coming from people that are interacting with the public. If we can help soothe these interactions by having the right data available when we have these interactions, we're going to make life of people that have interactions with the public so much easier. So that's how it can be enhancing, not displacing.
Karen, your views about AI growth and productivity?
Well, I think we're clearly not talking about a 2024 story here, right? This is a foundational technology. If we think about electricity, it took decades. This will have faster uptake. I'm not saying this will be decades, but we're not looking at this necessarily to move the needle across the economy. It takes a very broad footprint to move things macroeconomically. That said, I think, to Ludovic's point, and I love the optimism, but I do think there'll be jobs where we'll find that if your defensible moat of your job was the ability to convert human language grammar into tabular data, AI will do that better. This morning, it does that better already, and so there are places that will be jobs that will be displaced, and I think the question will be where there's opportunity. For example, in just an observation about the U.S., if the policies of nearshoring, right-shoring, reshoring are truly going to reach their end potential, that we must have robotics. It cannot be done with the human bodies we have alone. We need that productivity. So the combination of AI with equipment, with robotic equipment and a cobot atmosphere in the service sector would free up massive numbers of jobs that are doing things like picking goods in an Amazon warehouse. And I don't think anyone in this audience looks and says, gosh, I'd really hope my child or grandchild grows up to be fulfilling orders in an Amazon warehouse. So there's a lot of opportunity there to enhance and make jobs better, just stretching the time frame a little bit, which I know Ludovic was doing as well, and thinking about what are the first things that are in danger, again, that human grammar to tabular data, and where the potential is. And that, I think, is an advantage to the U.S. in particular and developed economies to enhance productivity domestically from it.
Thank you. Mario?
I think positive on growth, probably negative on employment in the short term, but then positive over time. Certainly the service sector is going to be heavily affected. We already see that in the financial industry where we work, right? And in my own institution, we have been asked to have initiatives using AI. Imagine the tons of data that we produce every single day, right? We are using that in a major way to generate indices and to know the clients better, their needs, etc. We use AI to, do some of the jobs that are easier, tabulation, etc., capturing data and putting into tables, right? So we have to find new jobs for the interns. Right, better jobs, better activities for them, right? In terms of the North-South divide, I think it's if you ask me a 5-year horizon, I think the difference will be quite small. 3-year, okay, but within 5 years, I think there will be a convergence. I mean, many countries, India is a key example. Many emerging markets are, becoming increasingly digital, right? In a somewhat surprising way, right? That's part of the earlier revolution. The fact that in many countries, in many emerging markets, you have way more cell phones than people, right? It's the case in Brazil and many others, right? So it's going to catch up pretty fast, I think. Not necessarily as fast as here, but it won't take that much longer.
Thank you. 30 minutes is never enough for these issue briefings, and certainly not when there's such a rich set of insights. I do want to use our final minute for one very quick round from each of you. What's your bright spot in the global economy? Where is it that you would look to see some signs of optimism, some potential sources of growth? I know we discussed already a little bit AI and a few other areas, but for this year, 2024, any one of you first?
I can jump right in. I think economies like India, Mexico, in several places should perform okay this year, right? And I think should be a source of support for global growth. I really do.
Thank you. We'll have Ludovic go next, and Karen gets the final
I'm
word.
an insurer, so I need to, I sell risk management. I need to people be theory. No, green growth. I think the potential of green growth, and even if it's a bit, ignited by public money, I think there is so much to do. I mean, the AI and sustainability together it's wonderful what we can do. So I'm very positive on this, and we've seen already so many innovations come to the market, and I'm very positive on what it's going to bring to us. Already in 24, we've already seen some in 2023, but I'm quite optimistic on this.
Thank you. Karen?
No, at Bain, we work with companies around the world, and the innovation that's happening below the thatch layer has nothing to do with what's happening at the GDP level. Nobody says, well, I had a great idea, but gosh, GDP's down 50 basis points, so I guess I'll give up. And that, I think, is always the excitement and cause for optimism.
Thank you very much. Thank you, Mario. Thank you, Karen. Thank you, Ludovic. Thanks to our audience in person and online. Thanks very much.